So what a crazy day it has been with the snow today, but what is another crazy day is the stock market. Another fantastic day in the market. Looking at HIMS, DraftKings, Mercado Libre, stocks are doing very well at the moment, but what isn't doing well is this guy. We're going to talk about three stocks I own today, three updates and three mixed updates. We've got these three stocks doing the total opposite directions. PayPal's going, what do you mean there's a bull market? I'm not joining in that. You've got Disney that's going, I'm joining in the bull market. And then you've got Alibaba that's kind of going, do I go that way or do I go that way? That one's still trying to make its mind up. So we've got three stocks that have brought out their updates and very much moving in very different ways. So yeah, hope you enjoy the update on these three guys and we'll get started. PS, by the way, I could not put this one in the video. ARM Holdings, a recent IPO. I actually IPO'd in September time at $60, and what an IPO this has been. It kind of gives you that 2021 vibes a little bit, doesn't it? Seeing these IPOs and they go up 100%, absolutely crazy. But having a fantastic day today, up 55%. It's been really nice to see my alpha wave get a bump up in the share price as well. Obviously a new client for ARM as well. But yeah, what a move from ARM. It's kind of getting into that Nvidia space where they came out and they said that AI is driving up a good demand. I've got to say that I looked at the earnings. I mean, the earnings were decent. They had an EPS beat. The revenue was a beat. The guidance was a big hike up. So they hiked up their guidance from $1.20 to $1.24, from $1 to $1.10. And revenue as well went from $3.16 billion to $3.21 billion from $3.02 by analysts. I mean, it's a decent upgrade, but I mean, I looked at the stock today and I went, 50% on this. Now, I don't know if you people are pricing in, but look at how much momentum Nvidia got when they started mentioning AI and how much they kept upgrading the guidance. I don't know if that's what analysts are kind of pricing in here, but I went, yeah, it's a good update and the stock's going to go up for sure on this. But once again, I'm looking at this stock and going, I don't know how this stock is up 54%. Absolutely crazy. Once again, kind of making me think, are we in a bit of a frothy market here at the moment? Having good earnings, nothing wrong with that, but 50% on those earnings, I don't know. Anyway, getting on to the stocks that this video is titled by, the whole point of the video. PayPal. So PayPal is looking at the bull market at the moment and going, I don't want any part of that. I'm going down. And the stock is currently down 11% as of recording this video. It is still off its 52-week lows, but it's definitely heading towards it. And PayPal at the moment just can't seem to get any momentum going. Now, looking at the stock being at 52-week lows or near 52-week lows and going down 11%, you would think PayPal has just brought out some horrendous earnings. And I've got to say, they weren't. PayPal's Q4 earnings were actually good. I would go so far as saying that they were probably 9 out of 10. If you look at EPS, the EPS came at $1.48 versus the consensus of $1.36. That's a fantastic beat. That is a really, really good beat by PayPal. If you look at the revenue, it came in at $8.03 billion compared to the $7.8 billion consensus. Once again, that's fantastic beats. And the total payment volume growth was good. The company was growing at 8%. These are very good numbers. A lot of companies wish they could do these numbers that PayPal are doing. Now, you're probably thinking, well, why is the stock down? And a lot of it was because of the guidance, but there was reason towards that guidance. Now, by the way, they actually announced a 9% layoff, which is going to massively improve the profitability in 12 months, by the way. There was a lot of few gems like that. How they're focusing on small business, profitable growth is there. But the reason why the guidance is probably so low is because they are wanting to sandbag it. They are wanting to set the bar really low. Obviously, the new management's come in. These numbers are good. The wild card is Alex Chris, and what is he going to transform the business into 12 months' time? Can he drag that extra bit of EPS growth in? Can he drag that revenue growth in? And at the moment, when you come in as a new management team, you set the bar really low. You do not want to come in your first few quarters, set the bar really high, you miss it, that will be game over. You'll lose Wall Street there. So that he's already setting the bar low so he can come in and beat it. And when you listen to Alex Chris on the conference call, which by the way, I thought was very good, he said that all the new initiatives that he's recently announced, he's not putting it all into the 2024 guidance. So he's first going to see the improvement in the financials before putting them in the guidance. So this is exactly what we're seeing. We're seeing sandbagged guidance. And if you actually listen to the conference call, they said that this is conservative guidance that they are giving. So at the moment, the market seems to be freaking out a little bit on the guidance side of it, but we knew this was going to happen. Set the bar low, beat it, and also be conservative on the numbers. This is what management want to do. So we have fantastic numbers and we have a CEO managing the company in the right way. And the thing is with the company is we can't judge the guidance just yet. Alex Chris is the wild card. We don't know exactly how much is he going to get this growth up by. We'll come back in 12 months and we'll see it. Now what I look at the moment is I'm already getting a undervalued company with great financials. The wild card is what is Alex Chris going to turn this business into. And if he can drive up fantastic numbers, it's going to be very exciting. So for me, I look and think for the valuation, these numbers are good. I think that he's doing the right thing with the guidance. And I look forward to the first 12 months and seeing how we can get those numbers up by the end of the year and start kicking some of those new initiatives in that he did say on the conference call. But when you're starting to look at the numbers that they're already doing without Alex Chris taking any of his new initiatives in there, revenue growth was up 9%. That's so impressive. When you look at operating income as well, up 39%, EPS up 61%, even on a gap basis up 19%. And as well, you got all these new initiatives, profitable growth coming in. You're having the job cuts coming in. They've announced, I think it was another 5 billion in 2024 of share buybacks once again. And I'm just looking at PayPal right now and I'm thinking, what does the market want? Like for me, I looked at those earnings and they were solid, conservative guidance, fair enough. It wasn't terrible guidance, by the way. Let's just make that clear. It wasn't terrible guidance. It was still good guidance. It was just a bit below what market was expecting. The beats are very, very good of earnings, and the stock goes down 11% at 52 close. And it's like, what does the market want from this? When you are PayPal and you are currently trading at 10 times forward earnings, and you've just come off a quarter where you've grown 8%, you've grown your EPS by 19%, you're buying back 5 billion of shares, and you have the wild card of Alex Chris. What does the market want? I don't know, but I'll tell you something. If the stock stays down here, and I think it is going to stay down here for a little bit, I'm trying to get a big buy ready. I'm trying to get a really, really big buy ready for buying up some PayPal, because even without the wild card of Alex Chris here, if they keep doing these numbers, this stock is cheap. You had the wild card of Alex Chris in, and if he can drag out that extra profitability and that extra revenue growth out here, it's even cheaper. It's a scary cheap how it could be. So I'm looking forward to PayPal in the next year and see what Alex Chris can do over there. Next one is Alibaba. So Alibaba looks a little bit strange because the stock actually ran up before earnings and then it dropped off earnings. But realistically, over the last 5 days, the stock hasn't really gone anywhere. So PayPal's kind of like not doing anything. It's not going down. It's not going up. It's stuck. Now I look at PayPal's earnings and I've got to say, Alibaba's earnings, sorry. PayPal for me was probably a 9 out of 10 earnings. I liked it a lot. Alibaba, I'm probably more towards a 7. I thought it was good. I thought there was room for improvement. That's where I was with Alibaba. But same again, I look at the market and I look at the market now pricing Alibaba at 7 times forward earnings and I go, what does the market want from a company that is trading at 7 times earnings? You look at the numbers, beat on EPS, beat on revenue, 5% growth. Very good. Now, you do look at the numbers, and I'm actually going to just scroll up on this one here. So I wonder if the market freaked out because they saw income from operations down, and it was down 36%. I don't know if that's why the market was freaking out, but there was a lot of one-time charges in there. If you take the one-time charges out, it was up 2%. So maybe the market was, once again, maybe a little disappointed because it wanted to see that maybe growing more in line with revenue, maybe growing faster than revenue. Maybe that's what it was looking for. Maybe that's why the market freaked out, and maybe that is some little bit improvement that we want to see there. We do want to see the company maybe growing a bit faster and maybe growing from an income basis a little bit stronger. But hopefully as we see a Chinese economy recover, that will happen. And that same thing goes to some of the segments inside the company. Same again, I don't know if they freaked out because they looked at some of the numbers inside the company and they saw the likes of Tmall and Taobao growing at only 2%. Maybe a Cloud at 3%, maybe something that they didn't like. But when you start looking at all the other parts of the business, the logistics side was up 24%, local services up 13%, digital media up 18%. There's still a lot of good growth in here, but maybe they would want to see the cloud, for example, start recovering. And maybe that's the key part where Alibaba does need to improve, and hopefully as the economy in China does improve, that also gets dragged up. So those are the things that maybe the market was disappointed with. But once again, I come back to the point of like, what do you want from a 7 times earnings company? isn't this kind of already priced in at these sort of levels? And if they do then recover, how much of an opportunity can that be? And originally the stock actually went up when they brought these earnings out, and then it gave it all back. And I think they straight away saw that they are going to add another 25 billion to the share repurchase program. So that means they've now got 35 billion available for the share purchase program. That's a lot. When you're a company at 181 billion market cap and you're buying those amount of shares, that is a big amount to be buying back. And same again, I'm going back to the same point, same that I'm saying with PayPal at 7 times earnings. What do you want to see from a bit? What more do you want to see? You got a company that is still growing profitability, revenue, buying back a ton of shares. They're trying to be shareholder friendly now. I don't think there's much more you can really ask from Alibaba at the moment with the numbers that they are doing. And that leaves us with the last one, which is Walt Disney or Disney. 11% up today. Fantastic day. Obviously, the one that's kind of joining in with the market rally. It's kind of kicking PayPal out and going, hey, this is how you do it. First time we've seen Disney break the $110 mark for a while. Now, obviously, Bob Iger come in and he's kind of seems to be going back to the old shareholders. He's been a lot more friendly around the profitability, dividend, share buyback. He's kind of looking, I think in my opinion, he's looking to attract the old shareholders back in. And an example of that is when you look at the profitability. You can see here, the earnings landed on the high side of profitability. They offered upbeat guidance for 20% growth in full year profitability. Once again, pointing out the cost cutting and the savings that they could make in here. Disney Plus numbers were a little bit weak actually. Obviously the reason why is because they've been hiking up. Very hard to have good numbers when you are hiking up the cost of your subscribers. You can see here 1.3 million in decrease, but what they're trying to do is get more from the current subscribers. So once these tough comps are passed, then hopefully they go back into subscriber growth. But obviously those are the price targets kicking in here. He said that they have also bought a 1.5 billion stake in Epic Games. He actually made a commentary about this on the conference call, and he said that he's surprised to see how much of screen time is getting taken up by younger people by games now. And it sounds like that Bob Iger is potentially looking at more gaming content as a driver for Disney going forward. They talked about, once again, driving profitability and driving through profitability from, it seems like they're not going to go down the route of the unknown. It sounds like they're focusing on things they already do and, moving in, still maximizing the parks, bringing out movies that are based on characters that are already built characters. So that definitely means there's going to be the 7th sequel of certain films as well. And all while adding in, I think the first share buyback since 2018. I think I haven't got the information down here now, but I think they hiked up the dividend by 50% as well. Once again, going back to the old shareholder base, which, saying things that they would like. So yeah, they definitely, the Bob Iger drive to profitability rather than the old one of Bob Chapek of driving growth. The focus on profitability is definitely here to see, and clearly the cost cutting and the profitability, the dividend hikes, the share buybacks pleased Disney shareholders as the stock went up. And as you can see here, I've just actually gone back and see Disney raises dividend by 50%, and you see here the EPS beat, it was $1.22 and the beat by $0.18, which is a very good beat. And like I said, I think that's Bob Iger playing a little bit tactical and kind of talking to the old shareholder base and saying, hey, come back, we are focused on profitability. I'm buying back shares for you for the first time for many years. I'm paying you a lot more of a bigger dividend like you used to have. Come back to us. And I think the Bob Iger plan is definitely in place and seems to be saying the right things that Wall Street and the old shareholders like. And that was rewarded today with the stock having a very good day. It's the first time that Disney stock has actually been above the $110 mark since February 2023, so over a year ago. So yeah, anyone that was buying Disney in the $80 range or even $90 range, it looks like you're starting to get some rewards there. So yeah, that was Disney. Hope you enjoyed the video. Let me know what you thought on PayPal's earnings. Let me know what you thought on Alibaba's earnings. And let me know what you thought on Disney's earnings as well. See you in a bit.